Winter 2001. Dodge County, Nebraska. A commodity crash, an energy crisis, and then September 11 and 4 family farms that had borrowed heavily on the advice of professional financial consultants filed for bankruptcy within months. Their lenders had QuickBooks, financial models, and bank-grade projections. Agnes Schultz, 70 years old, had a cedar chest full of handwritten ledgers going back to 1961. She had seen the crisis coming 8 months before it arrived. The farm credit services consultant who walked into her kitchen to sell her a leveraged expansion left with 14 pages of handwritten notes and no sale. What Agnes showed him that afternoon, nobody had thought to measure it in 50 years. The winter of 2001 arrived in Dodge County, Nebraska, the way all bad winters do, not with a single dramatic blow, but with a slow, grinding accumulation of cold and silence and worry that settled over the county like sediment. The fields had already given up their harvests by October. The combines were back in their sheds. The grain elevators in Fremont were full, and that was not a good thing, because when grain elevators are full, it means the market is glutted, and when the market is glutted, it means prices fall. And when prices fall in a year that has already handed Nebraska farmers 5 consecutive seasons of depressed commodity rates, the mathematics of surviving another winter become very difficult to work out on paper. Then September 11 happened. In the weeks that followed, the already sluggish export market for American agricultural commodities contracted further as global trade slowed and buyer confidence collapsed. Corn, which had been trading at $2.11 per bushel in August, slid toward $1.89 by November. Soybean prices softened. Fuel and fertilizer costs, already elevated by an energy crisis that had begun building in the early months of the year, showed no sign of retreating. The Farm Bureau's Mary Kay Thatcher had said it plainly by year's end. This was the 5th consecutive year of poor prices for virtually every agricultural commodity. American farmers would need help, or a great many of them would go under. In Dodge County, 17 farms were operating with debt-to-asset ratios above 60%, the threshold that agricultural economists define as highly leveraged. Several of those operations had taken on additional credit in 1999 and 2000, on the advice of lenders who believed commodity prices would recover. They had bought equipment, expanded acreage, signed long-term lease agreements. When the recovery failed to materialize and September 11 further compressed the export window, those farms found themselves caught between the fixed obligations they could not reduce and the variable revenues that kept declining. By February 2002, 4 farms in the county would file for bankruptcy protection under Chapter 12. Another 3 would restructure their debt under distressed terms. Agnes Schultz knew all of this was coming 8 months before any of it was filed in a courthouse. She knew it not because she had a computer or a subscription data service or a sophisticated financial model. She knew it because she had 40 years of handwritten ledgers stacked in a cedar chest in the back bedroom of her farmhouse, 40 years of double-entry bookkeeping in a precise, slanted German script, recording every transaction her 480-acre grain and livestock operation had conducted since she took over management from her father in 1961. And because she had been tracking, in the margin columns of those ledgers, a set of 23 financial ratios that her father had taught her to calculate by hand, ratios that no software package of the era displayed by default, ratios that told a story about her farm's financial health that balance sheets and income statements alone could never tell. Agnes was 70 years old in the winter of 2001. She had not attended college. She had not taken a finance course. She had learned accounting the way she had learned everything about farming, sitting at the kitchen table with her father, Heinrich Schultz, who had emigrated from Saxony in 1931 with a primary school education, a leather-bound notebook, and a conviction that a person who did not understand their own numbers was a person who would eventually lose everything they had built. Heinrich Schultz had arrived in Nebraska in the middle of the Great Depression. He had come not entirely by choice. Economic collapse in Weimar Germany had made staying as dangerous as leaving, and he had settled in Dodge County because a distant cousin had written that the land there was good and that a German-speaking man who knew how to work could find a footing. Heinrich knew how to work. What he also knew, because he had watched the Depression strip wealth from people who could not see it coming, was that financial ignorance was as dangerous as drought or disease. He had developed his accounting system over decades, a hybrid of the German double-entry tradition dating to Luca Pacioli's 15th-century codification, adapted to the specific rhythms and vulnerabilities of a Midwestern grain operation. The system was not complicated by design. It was comprehensive by necessity. Every transaction was recorded in two places, the account it left and the account it entered. Every month, Heinrich calculated a set of ratios from those entries that told him not just where money had been, but where the operation was trending and how far it was from danger. The 23 ratios Agnes inherited in 1961 included standard measures, debt-to-asset ratio, current ratio, working capital, but also a set of custom indicators that Heinrich had derived from observation and experience. The most important of these, the one Agnes's father had taught her to watch above all others, was what he called the Festkostendeckungsquote, the fixed cost coverage ratio, which measured the relationship between the farm's fixed obligations, mortgage payments, equipment leases, long-term debt service, fixed insurance premiums, and its variable revenue from crop and livestock sales. Heinrich had noticed, through the agricultural crises of the 1930s and 1950s, that farms did not fail all at once. They failed along a predictable trajectory, and the trajectory always began with a deterioration in this ratio that was visible months before the cash crisis became acute. When you write each number down by hand, Heinrich had told Agnes when she was a teenager, sitting at the same kitchen table where she would later teach her own grandchildren to balance a checkbook, you are forced to understand it. The software calculates for you, and when you no longer calculate for yourself, you no longer understand. A person who does not understand their own money will lose it. Agnes had never forgotten this. She had written it, in German, in the front inside cover of every ledger she had kept since 1961. Wer sein Geld nicht versteht, verliert es. Who does not understand their money will lose it. Brad Keller arrived at Agnes Schultz's farm on the second Thursday of March 2001. He was 36 years old, a financial consultant with Farm Credit Services operating out of the Fremont office, and he came carrying a laptop computer, a printed prospectus, and a level of professional confidence that was not entirely unwarranted. Brad had an agricultural finance degree from the University of Nebraska-Lincoln, and 7 years of experience advising farm operations across eastern Nebraska. He had helped 3 families restructure debt in ways that genuinely improved their financial positions. He was good at his job by the standards of his training and his era. The software Brad used was a customized version of QuickBooks Farm, augmented with a proprietary Farm Credit Services financial modeling tool. It could generate income statements, balance sheets, cash flow projections, and loan repayment schedules with considerable speed and visual clarity. It could model scenarios: what happens if corn prices rise 15%, what happens if interest rates drop a quarter point, and display the outputs in color-coded graphs that clients found reassuring. Brad had given presentations with this software to dozens of farm families, and the graphs had the effect that all well-produced graphs have. They made the future feel more legible than it actually was. What the software did not calculate by default, what its standard dashboard did not display, what its reports did not flag automatically, was the fixed cost coverage ratio that Agnes had been tracking since 1961. Nor did it track the 14-month rolling average of variable revenue per acre that Agnes maintained, nor the seasonal cash reserve adequacy index she had developed in 1974 after a hailstorm had interrupted her cash flow for 3 months, nor the input cost creep indicator that Heinrich had invented during the Korean War inflation of the early 1950s to track the rate at which operating expenses were rising relative to revenue. These measures were not part of any standard accounting framework. They were experiential instruments, built from observation across multiple agricultural cycles, refined through 40 years of handwritten monthly calculation. When Brad came to the Schultz farmhouse in March 2001, he came to discuss a specific proposal. 3 neighboring farm operations, the Hendricks place, the Vogel brothers, and the Jansen family, had each taken on significant new credit in the past 2 years to expand their acreage and update their equipment. Their lender was now encouraging them to refinance at a longer term and take on additional operating credit to carry them through what the models projected as a 2-year price trough before recovery. Farm Credit Services wanted Agnes to consider a similar restructuring. Her operation was well established. Her credit history was excellent. The models suggested she had the asset base to support a leveraged expansion that could position her farm for the recovery. Agnes listened to Brad's presentation without interrupting. She looked at the graphs. She asked him to explain the assumptions underlying the recovery projection. She asked what commodity price was embedded in the 2-year recovery timeline and where that price estimate came from. Brad answered these questions with the fluency of someone who had answered them many times before, citing USDA projections, futures market trends, and University of Nebraska extension analyses. When he finished, Agnes rose from the kitchen table, walked to the back bedroom, and returned carrying a ledger, the current one, 2001, already 4 months into its entries. She set it on the table between them and turned to the margin column for January. "I have been tracking 23 numbers every month since 1961, she said. "My father tracked them before me since 1935. I want to show you 3 of them." What Agnes showed Brad Keller that afternoon was not a refutation of his software. It was something more unsettling, a set of indicators that his software was not measuring at all, that were pointing in directions his models had not registered. The first was the fixed cost coverage ratio. Agnes had calculated it for every month since 1961480 consecutive monthly calculations, each written by hand in the margin of whichever ledger was current. In January 2001, her own ratio stood at 1.87, meaning her variable farm revenue covered her fixed obligations 1.87 times. Heinrich had established through experience that a ratio below 1.4 was a warning zone, and below 1.2 was a crisis signal. Agnes had never let hers fall below 1.65 inches 40 years, but when Agnes showed Brad the numbers she had been collecting not from her own farm, but from the summary data she had obtained through the Dodge County Farm Bureau's voluntary financial reporting program, to which she had contributed, and which she had been reading carefully for years, the picture was different. The aggregate fixed cost coverage ratio for the 17 highly leveraged farms in the county, as Agnes had calculated it from the aggregated data, had fallen from 1.52 inches January 2000 to 1.31 inches December 2000, and was trending toward 1.18 by her projection for the following autumn. At 1.18, by Heinrich's criteria, those farms were in crisis territory not yet, but by October or November, if commodity prices did not recover significantly. The second indicator was what Agnes called the Einkommensbuffer, the Income Buffer Index, which measured how many months a farm could continue to meet its fixed obligations from liquid reserves if revenue stopped entirely. The standard accounting metric of current ratio captured something similar but not the same thing. It measured current assets against current liabilities without distinguishing between liquid and illiquid current assets, and without accounting for the seasonal timing of farm revenue, which is not distributed evenly across 12 months. Agnes's index incorporated the seasonality that the standard ratio ignored. For the highly leveraged farms she was tracking, this index suggested that by late autumn 2001, several operations would have fewer than 2 months of liquid buffer remaining if revenue fell below projection. The third indicator was the input cost creep measure, Heinrich's Korean War invention. Agnes had been tracking fuel and fertilizer prices since the energy crisis began in January 2001. The rate at which input costs were rising, plotted against the rate at which commodity prices were recovering, showed a widening gap, not a catastrophic gap, but one that was compressing margins in a way that Agnes's margin column numbers made visually immediate, in a way that Brad's color-coded projections had somehow obscured. Brad Keller looked at Agnes's ledger for a long time. "Your software," Agnes said, not unkindly, "calculates very quickly, but it shows you the numbers it was designed to show. These numbers," she touched the margin column with one finger, "it was not designed to show. Nobody asked it to." Brad asked Agnes when she thought the crisis would arrive for the highly leveraged farms. She told him October or November 2001, assuming no significant commodity price recovery and no change in the fuel and fertilizer cost trajectory. If the general economy also softened, and Agnes had been reading the financial pages carefully since the dot-com collapse had begun in 2000, the timeline could compress to September. September 11 was still 6 months away. Agnes did not take on the leveraged expansion Brad had proposed. She thanked him for his time, walked him to his truck, and returned to the kitchen table where she spent the next 2 hours completing her March ledger entries in the careful, slanted German script her father had taught her. She did, however, call the Fremont Farm Bureau office the following week and ask whether she might present her analysis to the county agricultural extension group that met quarterly. The request was granted. Somewhat reluctantly, Agnes Schultz was respected in Dodge County, but a 70-year-old woman with handwritten ledgers was not, in March 2001, the kind of speaker that professional agricultural audiences typically sought out. She was given 40 minutes on a Tuesday afternoon in April. She used 28 of those minutes. She brought 3 ledgers, 1961, 1987A, Year of Severe Agricultural Crisis in Nebraska, and the current 2001 volume, and a single sheet of paper on which she had written, in her precise hand, the 23 ratios she tracked each month and their current values. She explained the fixed cost coverage ratio, the income buffer index, and the input cost creep measure. She showed the trajectory of the county's aggregate numbers and explained what Heinrich's thresholds predicted for late 2001. She recommended that any farm operating with a debt-to-asset ratio above 55% immediately calculate its fixed cost coverage ratio and compare it against her thresholds. She offered to review any farm's numbers privately, at no charge, if they brought their records to her kitchen table. 11 farmers came to Agnes Schultz's kitchen table between April and July 2001. 7 of them were among the county's highly leveraged operations. Of those 7, 5 made significant financial adjustments over the following months, renegotiating lease terms, reducing operating credit lines, delaying equipment purchases, restructuring debt at fixed rather than variable rates, based on the picture that Agnes's ratios revealed when applied to their own ledger data. 2 declined to make changes, believing that the recovery projections from their lenders and the USDA were more reliable than an old woman's handwritten calculations. Those 2 farms filed for Chapter 12 bankruptcy in February 2002. The 5 that followed Agnes's analysis survived the crisis. Their margins were compressed. Their 2002 incomes were difficult, but they remained solvent through a period that drove 4 county farms into bankruptcy and sent 3 others into distressed restructuring. Brad Keller came back to Agnes's kitchen table in November 2001, 6 weeks after the September 11 attacks had accelerated exactly the economic slowdown Agnes had projected. He came not as a salesman this time. He came, he said, because he wanted to understand how she had seen it coming when the software had not. Agnes made coffee. She set the 2001 ledger on the table between them and opened it to the January margin column. She walked Brad through each of the 23 ratios, explaining the calculation methodology, the threshold values, and the observational basis for those thresholds, some from Heinrich's German agricultural tradition, some developed by Agnes herself through observation of the 1,974 droughts, the 1980s farm crisis, and the commodity depression of the late 1990s. Brad had brought his laptop. He opened it beside the ledger. For the first time, he was not trying to show Agnes something. He was trying to learn. "Why doesn't the software track these?" he asked at one point, looking at Agnes's fixed cost coverage ratio calculation. "Because the people who built the software were not farmers," Agnes said. "They were accountants. Accountants look backward. My father was a farmer. Farmers look at where the field is going, not where it has been." This distinction between accounting that describes the past and analysis that anticipates the future became the center of a conversation that lasted 4 hours. Brad took 14 pages of notes. The first time in his professional career, he had filled that many pages in a single meeting. Agnes spoke carefully and deliberately, the way a person speaks when they have spent 40 years thinking about something and are for the first time given an audience that is genuinely listening. When it was over and Brad was putting on his coat, he stood at the kitchen door for a moment. "I advised the Hendricks family in 1999 to take on the credit they used to expand," he said. "The Hendricks farm had filed for bankruptcy in February. If I had been running your ratios against their numbers when I gave that advice, what would I have seen?" Agnes went back to the table and opened the ledger to a page she had already marked. She had, as it turned out, been tracking the Hendricks numbers in aggregate since 1998, using the Farm Bureau's voluntary reporting data. She showed Brad the column, the fixed cost coverage ratio for an operation of the Hendricks size and debt profile, with their revenue pattern, had crossed below the 1.4 warning threshold in March 2018, months before they filed for bankruptcy. Brad Keller was silent for a long time. "I could have seen that," he said finally. "Yes," Agnes said, "if you had known to look." What followed Agnes Schultz's kitchen table consultations was not immediate or dramatic. The mechanisms of institutional change are slow by nature, and a 70-year-old German heritage farmer with handwritten ledgers does not typically alter the standard operating procedures of a regional agricultural lending institution through a single winter of conversations. But Brad Keller was not a man who, once confronted with a better measurement, was content to return to the inferior one. He spent the first 6 months of 2002 doing something that was not in his job description. He went through the Farm Credit Services client files for 17 farms that had experienced financial distress between 1997 and 2002, and retroactively calculated Agnes's 23 ratios from the historical data in those files. In 15 of the 17 cases, at least 3 of Agnes's indicators had crossed their warning thresholds, an average of 11 months before the farm's financial crisis became visible in the standard metrics the software tracked. He wrote this up as a 12-page internal analysis and submitted it to Farm Credit Services Regional Management in Omaha in August 2002. The analysis was received with the cautious interest that large institutions typically extend to unwelcome suggestions that their existing processes might be inadequate. There were 3 meetings. There was a request for additional documentation. There was a review by the institution's agricultural finance specialists. In 2004, Farm Credit Services quietly revised its standard client assessment protocol to include 7 of Agnes's 23 indicators. The fixed cost coverage ratio was first on the list. The seasonal income buffer index was second. The input cost creep measure was fourth. The revision was described internally as an enhancement to early warning financial monitoring and was attributed in the official documentation to research conducted by the institution's own specialists. Brad Keller's name appeared in a footnote. Agnes Schultz's name did not appear at all. Brad wrote to Agnes when the revision was implemented. He drove to her kitchen table one more time and told her in person what had happened. Agnes received this information with the equanimity of a woman who had never expected credit and who understood that the purpose of a good instrument is to be used, not to be acknowledged. 7 out of 23, she said. They said the other 16 were too complex to integrate into the standard dashboard, Brad said. Agnes nodded. The other 16 are the ones that take 40 years to understand, she said. You cannot put 40 years into a dashboard. The connection between Agnes Schultz's kitchen table consultations and the University of Nebraska Lincoln's agricultural finance curriculum was established not through any direct institutional channel but through a probably graduate student named Elena Kovach, who came to Dodge County in the autumn of 2003 to research the 2001-2002 farm crisis for her master's thesis in agricultural economics. Elena had been given a list of farms in the county that had survived the crisis financially intact, and Agnes Schultz's 480-acre operation was at the top. When Elena arrived at the farmhouse and Agnes set the cedar chest of 40-year ledgers on the kitchen table, Elena spent 2 days reading through them before she fully understood what she was looking at. Her thesis, submitted in 2005, devoted a full chapter to the Schultz accounting system, with particular attention to the 23 custom indicators and their predictive accuracy during the 2001 crisis. The chapter included a detailed comparison between Agnes's indicators and the standard Farm Credit Services dashboard metrics, showing, with the retroactive data Brad Keller had compiled, the average 11-month early warning advantage the handwritten system had demonstrated. The thesis was read by Dr. James Holloway, a professor of farm financial management at UNL, who had been developing a course on agricultural financial analysis. Dr. Holloway contacted Elena, then contacted Agnes. He drove to the farmhouse in the spring of 2006. Agnes made coffee. The cedar chest was opened again. By 2008, the UNL Department of Agricultural Economics had incorporated the Schultz case study into its farm financial management curriculum, where it has remained. The case study is titled The Schultz Ledger: Empirical Indicators in Traditional Farm Accounting, and is used to illustrate the distinction between retrospective accounting and prospective financial analysis. The fixed cost coverage ratio is now calculated as a standard exercise in the course's second unit. The Heinrich Schultz threshold values 1.4 as warning, 1.2 as crisis, are printed in the course textbook. Agnes Schultz did not attend the UNL lecture in which her system was first presented. She was 77 years old that year and did not drive long distances. But Dr. Holloway sent her a copy of the course materials, and Agnes read through them at her kitchen table, the same table where Heinrich had taught her to write each number by hand because writing it meant understanding it. She found one error in the course materials, a small algebraic misstatement in the fixed cost coverage ratio calculation, and wrote Dr. Holloway a letter correcting it. The correction was made in the next edition of the course textbook. Agnes Schultz died in March 2019, at the age of 88. Her farm was inherited by her daughter Carol, who continued to operate it, and who learned the 23 ratios from her mother in the same way Agnes had learned them from Heinrich, sitting at the kitchen table, writing each number by hand, understanding what it meant before moving to the next one. The cedar chest with 40 years of ledgers 1961 through 2001, Agnes's handwriting, and the 15 additional volumes covering 2002 through 2018. A total of 58 consecutive years of double-entry records was donated in 2021 to the University of Nebraska Lincoln's Agricultural Archive, where it is cataloged as the Schultz Farm Financial Records Collection. Brad Keller retired from Farm Credit Services in 2017. In his retirement, he teaches a continuing education workshop for agricultural lenders called What the Dashboard. Doesn't show a reference to the conversation he had at Agnes Schultz's kitchen table in November 2001. The workshop covers the 7 indicators Farm Credit Services integrated into its standard protocol in 2004, plus additional early warning metrics that Brad has developed in the years since. He opens every workshop session by writing, On a whiteboard at the front of the room, the sentence Agnes wrote in German on the inside cover of every ledger she kept: Wer sein Geld nicht versteht, verliert es. He tells the participants that the sentence was written by a man who arrived in Nebraska in 1931 with a primary school education and a leather-bound notebook, and that the man's granddaughter used it to see a financial crisis coming 8 months before anyone else in the county did. He tells them that the crisis came anyway. It came for other farms whose lenders had sophisticated software and color-coded graphs and USDA recovery projections. And he tells them that Agnes Schultz's 480 acres survived it because a woman sat at a kitchen table every month for 40 years and wrote each number down by hand and forced herself to understand what it meant. Then he tells them that this is what early warning looks like. Not an algorithm, not a dashboard, a person who understands the numbers well enough to notice when they are trending toward danger before the danger arrives. The workshop has a waiting list. By 2024, the oregano of financial analysis, the idea that deeply observed, custom-built, experiential measurement systems can outperform standardized software in detecting farm financial risk, has moved from the margins of agricultural finance into its mainstream. The Farm Financial Standards Council, which establishes benchmark metrics for agricultural lending across the United States, published a guidance document in 2022, recommending that lenders supplement standard dashboard metrics with operation-specific early warning indicators tailored to the individual farm's cost structure and revenue pattern. The guidance document cites 4 academic studies. One of them is Elena Kovach's 2005 master's thesis. The 7 indicators that Farm Credit Services integrated in 2004 originally derived from a set of 23 that Heinrich Schultz had developed between 1931 and the early 1960s, refined by Agnes Schultz across 4 additional decades of handwritten monthly calculation, are now included in the standard protocols of 11 regional agricultural lending institutions across the Midwest. No software platform displays all 23 by default. Brad Keller has asked about this. The answer he receives from software developers is consistent. The other 16 require contextual judgment that cannot be automated. The threshold values depend on the specific operation, the regional commodity market, the farm's historical revenue pattern, and factors that change meaning depending on what has happened in the previous 12 to 40 years of the operation's history. In other words, the other 16 require exactly what Heinrich Schultz said they required when he sat at a kitchen table in Dodge County, Nebraska, and taught his daughter to write each number down by hand. They require understanding. And understanding, as Agnes Schultz demonstrated across 58 consecutive years of ledgers, is something that must be earned one number at a time, 1 month at a time, with a pen in your hand and no software to do the calculation for you. The Cedar chest sits in a climate-controlled archive at the University of Nebraska-Lincoln, 58 ledgers, precisely dated on the spine in the same slanted German script, each one opening to the same sentence on the inside cover. Wer sein Geld nicht versteht, verliert es. Who does not understand their money will lose it.